and welcome to today's session of Indonesia Property Market Update for the first half of 2021 Developers and Investors Session. Before we start our webinar, we have a few information in regard to our webinar. The first one is the audio and video for webinar participants are being disabled to avoid noises, and we will only enable audio and video for panelists. This webinar is being recorded, and we will share the recorded file and presentation slides tomorrow morning. We will have a question and answer sessions at the end of the webinar. Please feel free to type your question in the questions box below. And although we may have a limited time to answer to your questions, but we will send your unanswered questions answered by our experts to your email inbox. If you need any help with the webinar, please type your questions in the chat box, and our webinar host will help you. Along with the recorded version tomorrow, we will also send a survey link for you to fill. We appreciate your time to fill out the survey. First, I would like to introduce you to our today's presenter. Our keynote speaker will be delivered by our Managing Director for Colliers Indonesia, Bapak Mike Broomell. And then we will also have our Head of Research, Bapak Ferry Salanto, our Head of Office Services, Bapak Bagus Adikusumo, our Head of Capital Markets and Investment Services, Bapak Steve Atherton, our Head of Advisory Services, Ibu Monica Koesnovagrill, and unfortunately, Bapak Rifan Munansa, as our Head of Industrial and Logistics Services, will not be able to be here today, but we have our Senior Associate Director of Industrial and Logistics Services, Bapak Freddy Hidayat, and we also have our Head of Retail Services, Bapak Sander Halsema. So I think without further ado, please welcome Colliers Indonesia Managing Director, Bapak Mike Broomell, for his keynote speaker. Pak Mike, the floor is yours.
Thank you, Auntie. I'd like to wish everybody a good afternoon and thank you for joining our webinar. Today, our team of experts will present you with both our observations about the current property situation and other insights that they may have. As I'm sure you realize, as developers and investors, the health of the property market varies greatly according to asset class or sector. So we can't paint the property industry with a broad brush. So I will begin with a brief overview of the different asset classes, and then our experts will cover these sectors in more detail. First of all, we'd like to note that the Indonesian government's recent PPKM measures, which were extended yesterday for at least another week, will, as you might expect, continue to hit the hotel, retail, and office markets the hardest. However, the industrial and logistics sectors continue to perform well due to the growth in e-commerce during the pandemic. And also there's a lot of interest from data center operators because of that as well. With regard to the residential sector, the development of single-family housing in the suburbs is another bright spot, while the apartment market continues to struggle. The same is the case with expatriate housing, because many foreigners, as you probably are well aware, have left Indonesia due to the rising number of COVID cases. And then those expats that would love to come to Indonesia and like to do business aren't able to right now because they need to have a kitas or a kitab in order to enter the country. The Indonesian government has now signaled to us that what the vaccine distribution is going to be in 2021 and 2022, and Monica will be sharing that with you later. If the vaccine distribution goes as planned, we hope to see signs of an economic recovery by the end of the year. So there is light in the end of the dark tunnel we now find ourselves in. Even now, we do see investors and developers who have approached us and we're talking to about their interest in investing in the property market here. And these parties are finding receptive audiences with property owners and developers who are looking to sell their properties and seeking joint venture partners. So on that note, I'd like to conclude my talk with the hope that you do enjoy today's webinar and you receive helpful insights from the presentations of our property experts. Please do feel free to reach out to me or to my colleagues who will present today if we can help you in any way. Thank you very much.
Thank you, Pak Mike, for the keynote speech. So we would like to proceed to our first presentation. It will be from the investment sector or investment market. Ibu Monica Koesnovagrill, as the head of advisory services, will start for this session, and then we will be followed by Bapak Steve Atherton as the head of capital markets services. Ibu Monica dan Pak Steve, over to you.
Thank you, Auntie. So good afternoon, ladies and gentlemen. I'm Monica from Advisory Services. So the COVID-19 pandemic dragged down Indonesia economy from 5% in 2019 to 3% in first quarter 2020 and achieved its bottom at -5% in second quarter. However, from the chart, you could see that Indonesia was able to show a continuous increasing trend of economic growth afterwards. As at first quarter 2021, economic growth was recorded at -0.7%, almost zero. This positive trend is expected to continue to achieve 3.9% by end of 2021. This positive expectation is also reflected by higher economic projection in 2022 at about 5%, similar to the level of pre-pandemic. Next. The negative economic growth did not hold investment interest in Indonesia. From this chart, we could see that year 2020 recorded 2.1% investment growth than in 2019. An interesting phenomenon was shown by a slightly higher portion of on investment value outside Java Island. It's about 52%. A massive infrastructure work in Sumatra, especially the Trans-Sumatra Toll Road, gave confidence to investors in investing in Sumatra. Next. Either for foreign or domestic investment transportation, transportation, warehouse, and telecommunication sector was one of the most preferred sectors. It showed potential development of logistics sector in Indonesia. And apart from this sector, domestic investment, which also played significant role, had construction, housing, industrial, and office building as dominant investment sectors. It showed that property and construction was the most attractive investment sector in 2020. Next. The above assumption on economy would rely heavily on the success of vaccination program. Theoretically, herd immunity would be taken place should 77% population be completed their full vaccination dose. Based on data compiled by Bahana from Ministry of Health, as at 15 July 2021, of the 208 million population, as the herd immunity target, only 8% had fully completed their vaccination program, although about 19% had taken their first dose, but this 8% is taken first and second vaccination. Next. To be able to provide full vaccination program to Indonesia, the government ordered a total of 487 million vaccine doses, which could cover the needs for the entire 77% population for the herd immunity. By 15 July 21, 129 million vaccine doses were received by the government, and the balance is expected to be fully received by mid 2022. Looking at the vaccine doses supply and assuming that the vaccination speed could be accelerated, property market is expected will be recovered at the earliest of end 2022 or early 2023. Thank you, Auntie.
Thank you, Bu. Pak Steve, the floor is yours. Pak Steve, I think you're still on being mute, Pak.
Thanks, Auntie, and thank you, everyone, for joining our webinar this afternoon. Just to begin, the investment climate has continued to deteriorate, where more and more developers and property owners with debt are facing cash flow problems because we're 16 months into this global pandemic. So banks are becoming less patient. They're taking more firm action on defaulted loans, and we are seeing more debt restructuring situations unfold. And that is putting timeframes on selling processes where borrowers and debtors that face creditor situations have to find solutions. So there are opportunities in the market. Local investors and foreign investors, however, are looking mostly for distressed pricing, or they're looking for very strategic locations. We're often seeing in this market discounts in the range of 20 to 30% or more from valuations pre-COVID. And prime locations that before now have been rarely on the market are becoming available for strategic investors who really have a medium to long-term view. This is quite an interesting time and could prove to be very fortuitous for them in the medium to long term. Sectors including office, retail, hospitality, and apartment remain under pressure, which creates opportunities for these medium to long-term investors. We're not seeing many retail Main Street investors in the market today, but for the Wall Street, the experienced property players, this is a time that they are paying very close attention to the opportunities because they know this property market, these challenging times won't last forever. Strongly capitalized developers are starting to shift their next projects to mostly affordable landed housing and residential middle up type of niche markets where they'll be willing to go a little bit higher in price, say 3 billion to 5 billion range, as well as the data center and the logistics space continue to prosper. Next slide, please. We are seeing some bank debt selling off defaulted loans with private equity credit investors picking up those assets and looking to then repackage those assets and divest to experienced investors and operators who can provide asset management services and achieve the kind of performance and yield that is possible from good quality assets. We see this bank and creditor activity being one of the more active sectors over the next 12 to 24 months. Next slide, please. So for the second half of 2021, we think the opportunities for local investors and even foreign developers is to form new relationships with capital partners or developers that have expertise that can help you to reposition your project or portfolio. For example, the capital partners that Colliers is frequently dealing with, when they're looking for opportunities in, say, affordable housing, they want to see a local partner that has affordable housing experience. So if you've got prime property, prime location that's suitable for affordable housing, but you've never done it before, then putting together a partnership where you have the local expertise for proven track record of developing that product type of affordable housing, that will be attractive to an international capital partner. Or if you want to move into, say, the healthcare, we've been having more and more discussions with healthcare because, hospitals have been busy through this pandemic, and the healthcare section is actually performing pretty well. So if you have a project that can be converted to healthcare, or you have a site that's suitable for healthcare, that's great. But if you don't have any healthcare background or experience, it's going to be difficult for a global capital partner to have a lot of confidence to invest money. So putting together partnerships that will strengthen your execution, your positioning will be very helpful in constructing joint ventures. The other thing that's going on that I find interesting today is the construction technology that's becoming available. We're seeing several firms with prefabricated style factory housing where there's robotics and high quality, scalable construction techniques for production of like landed housing. We're seeing the landed housing costs can be produced in these prefab factory productions in the range of, say, 2.2 million per square meter up to 2.8, 2.9 million per square meter, which is, I think, quite an interesting price range when you consider the time savings when you use this type of construction, where a home can be assembled in 7 to 10 days, delivered from panels at the factory. And the other thing that's something to keep in mind as you go forward with new projects today is the design, and how you can make your design more suitable in the future for open areas and having touch-free devices and mixed uses going forward. Maybe a 60-story new tower might not be all office space. Maybe you have to consider being more creative and doing more surveys with customers and finding out what they need. That's all I have for now. Thank you.
Thank you, Pak Steve and Ibu Monica, for the insights. We'll move to another sector, which is office market. We will have Bapak Ferry Salanto as our head of research. Pak Ferry will explain about what happened on the first half of 2021, and also a little bit about the forecast of the remainder of 2021. And Bapak Bagus Adikusumo will also be here and explaining the recent updates on the market and also the strategies of or opportunities for the remainder of 2021. Pak Ferry and Pak Bagus, over to you.
Thank you, Auntie, for giving the chance. Good afternoon, all. Now it's time for me to update what is going on in the office sector. I'm sure if you follow our update through the regular market report or through the media, you will notice that the oversupply situation is in the office industry had already happened even prior to the pandemic. The pandemic itself has indeed worsened the situation to all property sectors, including office sector. The good news is from the supply projection up to 2024, the growth will likely to be steady and relatively low. Even if you look at the right-hand chart, which is the annual supply projection, the average future stock for the CBD is only below 150,000 square meter, where in the normal time, the annual average could reach above 200 or even until 400,000 square meter. In outside the CBD area, supply will grow at below 100,000, which is also quite low compared to the previous years. And also, as you can see from the chart, we still expect that projects in the pipeline are already scheduled for completion in 2022. Therefore, next year should remain a challenging year for office sector, particularly for developers. Started 2023 onward, supply projection will taper off, including in 2024, where there will be no new office project being available. This is quite understandable because 2024 will be an election year when most of the business activities generally slow down. Next slide, please. Again, if you look at the occupancy chart, it shows that a downward trend, even since a few years back. Office market was in the 12 o'clock cycle back in 2020, 2012 and 2013 period. This also suggests that the recent pandemic situation was not the only cause of the slowdown in the office market. For the first time, because of the oversupply situation, office occupancy is below 80%, which is the history high, history low. I mean, during the pandemic, space reduction is quite evident, mainly because right now many companies found that work from home policy is quite effective to be implemented. Concerning that, many companies has also been adjusted with this new policy arrangement. In the meantime, the asking rental rate, if you could look at the right chart, shows that the market is not supportive for most developers. We have seen rental correction and more significant correction of the or discount in the transaction level, depending on the space and tenant, how much space tenants is taking, and of course, depending on the brand of the tenants. So to conclude, the office sector from the market perspective, this year will remain a challenging year for office market because it needs economic growth acceleration, which we don't expect to see this year. As you can see from Monica's slide previously, our GDP is projected to be lower than 4%, which is not enough to lift the overall office market. So I think that's all from me. I pass it to Bagus now.
Thank you, Ferry. Thank you, everyone, for joining our webinar. At the moment, as Ferry has mentioned, the office market in general continues to be oversupply. Rent and occupancy rate continue to be pushed down. The first time that now the occupancy rate we're gonna go below 80%, and we projected it's gonna go even lower further and at the end of 2022. Actually, before there is any COVID, a lot of supply will be coming into the market in 2021, but because of the COVID and then all this emergency situation that the construction is delayed, what is completed in 2021 become 2022, 2022 become 2023. And then our recent leasing transaction, rent in general has come down between 20 to 45% from the asking rent, depending on the size of the transaction. As market continues to be tenants market, landlord will have to be flexible and accommodative to the tenants' needs, meaning that landlord would be providing a lot of consideration for the tenants to stay in the building. And then as Pak Ferry also has mentioned that the correlation between the property business and GDP growth is very strong. So if the GDP growth does not show an increasing trend, demand for office space continues to be limited, and that will be challenging. Major occupiers continues to be the same: technology-related industry, e-commerce, financial technology, consumer products, logistic business, and telecommunication-related industries become the main occupiers of office space until now. Next. Now, what is different in the strata title market compared to our first webinar for Q 2020, that we start seeing owners of strata title space disposing their asset at a market price, which so far our evidence has shown that the market price has come down between 18 to 33% compared to the pre-COVID price. But generally, it stays the same though, that strata title space owners would rather rent and offer a very attractive space, a very attractive rent, instead of selling at a big discount. So that stays the same. And the reason for the strata title space now considering selling is that if you have space strata and sitting vacant and empty, you will have to pay service charge. If your space is big, it's not a small amount of service charge that you have to pay every month. So not only optimizing the asset, they also would rather have tenants pay the service charge. That is why they're offering a quite attractive rent. Next. Work from home policy continues to be a major part. After 15 months working from home, we see majority of the companies, when they renew or restructure their lease, they reduce the space, ranging from 15 to 40%. And this fact, this space that is rendered or reduced will be added to the market and makes it even more tougher for office market to recover. And for the landlord also will be more challenging to fill up the space. And then we will see in the future that work from home policy will still be continued permanently. So it'll be a hybrid model between 50% working from home and then within 50% working from the office. Efficiency becomes also one of the key elements here for many companies in order to run their business. And at the same time, while they're reducing the space, they also, a lot of companies, they redesign the current layout. Instead of a lot of closed office or fixed desk, it's going to be more open desk, open office. So in order to show more flexibility and collaboration, so less space, more productivity, and then hopefully with this condition, they could adjust with the sales volume and then achieve the revenue that they're getting. In terms of renew or relocate, what is also changing is that in general, relocation still perceived by many companies as high risk to the business. But after 15 months of working from home, adjusting and running the business with the pandemic condition, we start seeing a few companies decide to relocate to a new building, taking advantage of the tenants market. Next. Vaccines is the only solution to the problem because the ability to vaccinate as many people and as quickly as possible is the solution. As Ibu Monica has shared before, that supply is not an issue. The issue on the speed, delivery, and also on the, unfortunately, there are just people that don't want to be vaccinated. So we all need to work together to campaign convince these people to want to be vaccinated, because we would like to achieve herd immunity as soon as possible. I know it's tough and challenging, but that's the only solution. And then at the same time, also working from home policy has been going on for more than 15 months. So hopefully with the supply is not an issue, herd immunity is getting closer and closer to be achieved. Let's have a positive thinking and confidence here. We could go back with the normal economy. Higher GDP growth means increase in the property business, increase in the demand for office space. And at the end of the years, demand for office space will also catch up with the supply. And then office market will go back to the great level of performance in 2011 and 2014. Next. Strategies and opportunities. Landlords with this condition of oversupply, tenants market, rental and occupancy rate push down, will have to show flexibility, advised to show flexibility and accommodative to keep the tenants stay in the building, and even more flexibility and more accommodative in order to secure a new lease. Now, flexibility that I'm talking about here is referring more into rent-free. You could put high face rent and then lots of rent-free in order to go net effective rent, so that the net effective rent meets the expectation of the tenants. Free parking, option to surrender with no penalty, without allowance. Also, this is very important because right now, global having COVID-19 situation, it's not easy for any companies right now to ask for the global to spend the capex. So without allowance by the landlord is advisable, amortize over the lease term, option to renew with rental caps, sublease, holdover, so other related matters. So not only a competitive rent, but also the other flexibility. Another thing that landlords are advised to focus is more focus on occupancy rate. If your building currently is running, occupancy is lower than 50%, occupancy rate is the key in order to achieve 50%, in order to achieve 70 or 75%, so that your building could be self-financing, service charge from the tenants will be able to cover the whole of building operation costs. Another thing to think about also advisable is part of the flexibility is to to have half floor, 1 floor, maximum 2 floors, agile working space. So now not only the companies that sign for a traditional lease 3 to 5 years in your building, when they want a project and they need to expand, they don't need to sign another 3 to 5 years. They could just rent 3 months, 6 months, 12 months on the project period in your building. The way you do it, you could do a joint operation with co-working space operator. Also, you can do it yourself if you are experienced. Another thing that is also an opportunity for landlords nowadays is buying income producing properties or strategic located land bank, or also under construction projects that are halted at a discounted price. That will be the presentation from me. Thank you everyone for listening. Turn the over back to you, Auntie.
Thank you very much, Pak Bagus and Pak Ferry, for the presentation. We'll move on to our next sector, which is retail market. In this sector, we will still have Pak Ferry Salanto explaining about the retail overview of what happened in the first half of 2021, along with some forecasts of what happened in 2021, the remainder of 2021. And followed by our head of retail services, Bapak Sender Halsema, who will explain about his findings and also his point of view of what will happen in the remainder of 2021. Pak Ferry and Sander, over to you.
Thank you, Auntie. Okay, now it's time for me to update on the retail sector. If you see the supply status projection here, the good things about retail sector is that supply growth has been quite moderate. If you recall, retail moratorium back in 2012, that was quite effective in curbing the expansion of retail projects. Now with the pandemic, retail is the sector most hit by the pandemic, because last year, if you also remember, when PSBB was implemented, the impact was definitely felt by both landlord and retailers. And even this recent PPKM Darurat, followed by PPKM level 4 or whatever the name is, has given further pressure to retailer, which is also impact to the landlord. So here, if you look at the right-hand chart here, this is the projection of retail both in Jakarta and Bodetabek annually. It still grows quite moderate. We don't see the fear of oversupply situation in the following years. Next slide, please. But if you look at the occupancy, since 2016, we see a downward trend. Even until now, occupancy is only like 71, 72 for the Jakarta area and Bodetabek area, while the rental tariff is, has been quite stable. But again, this is what we'll calculate from the asking rent. So the transaction rent could be lower role than this, but it really depends on the tenants and landlord negotiation, because it's a very case by case situation. But in order to cope with the pandemic, both landlord and tenants, they try to find a win-win solution in order to find a way how to still survive in this current tough market. I think that's all from me, Auntie. Thank you.
Thank you, Pak Ferry. So we'll move on to Sander.
Hello everyone. Good afternoon. Thank you for dialing in for this webinar. I think the retail market is currently in a very similar state as it was a year ago, like Pak Ferry also said, which of course is not very positive. As a matter of fact, we have been talking to both large national and international retailers in Indonesia, and they say that the current situation is actually worse than compared to last year. And that's because, of course, the malls are closed right now, but also because their standalone sites are affected by the PPKM measures put in place by the Indonesian government. And so they say it's worse than it was last year. Like I said, the Indonesian government has implemented the PPKM restrictions or the community activity restrictions on Java and Bali. And yesterday, this has been extended until the 2nd of August with some relaxation on the measures, I would say. So if you look here on the slide on the left side, malls and shopping centers are allowed to operate at 25% now, it seems, and until 5 p.m. in the afternoon. Grocery stores and supermarkets can still operate daily until 8 p.m. at 50% capacity. F&B businesses allowed to open until 8 p.m. and have dine-in now. Apart from takeaway and delivery services, they can have dine-in for 20 minutes per person. And so, like I said, these new PPKM level 4 measures, I think these are put in place until at least the 2nd of August. Now, in terms of the expected response on the right side here of the slide, it's also a bit similar to what it was last year. And so we see a lot of retailers, of course, requesting for rent-free periods because the malls were closed for a couple of weeks. And so they couldn't operate, of course. And we expect now that the measures are being relaxed a little bit, that retailers will still ask for some rent rebates, so percentage discount on their rents. Similar to last year as well, they will still continue to do portfolio reviews, really looking at outlets that are performing well and outlets that are not doing so well, and they will of course close those that are not doing well in Indonesia, and then also their expansion is less aggressive, I would say. Retailers, after what happened last year and what's happening now, still retailers, of course, need time to get back on their feet and to restabilize their financial situation. And so we see delays in fit out in new malls that are about to open, also in standalone locations. And we also see a lot of retailers that request for delays in their handovers dates. Next slide, please. So what can landlords do on the short term? Of course, landlords can be flexible in terms of the rent and service charge that they charge to their tenants. Now the malls have been closed for a while. So like I stated, retailers will ask for rent-free periods. And as a landlord, it's obviously important to have a strong tenancy mix and continue to work with the tenants that are doing well in their malls. But it might also offer an opportunity for landlord to assess which tenants are not performing so well. You might come to an agreement with them to close their outlets in your mall and find replacement tenants that are potentially perform better. For existing assets, you might want to consider to create more outdoor space. We've seen really that the Indonesian shoppers, I would say, consumers are more used to be outside now. They feel more safe. Initially, before the pandemic, of course, most Indonesians like to be in an air-conditioned environment, but now since the pandemic, I think people are getting used to being outside more and dine there and shop there. So if possible, you might want to consider create more space outdoor or semi-outdoor. And you could improve your infrastructure for online order fulfillment so that, for example, it's easier for your tenants to get their product that has been sold online to the Gojek drivers or the Grab drivers that pick it up and deliver it, and make sure they don't have to pay parking when they park their motorbike to pick up ordered items. And so try to work with the retailers really to make it as easy as possible for them to sell online as well, would definitely help. Next slide. On the mid-long term, of course, when malls are allowed to open again, which seems to be slowly becoming the case, landlords should maintain strict health and COVID protocols, of course, to reassure their consumers that everything is safe to visit their mall. You might want to consider, if not already done, to help your tenants with technology by creating an app, for example, which is an additional channel for your tenants to sell product through to mall visitors. They could purchase items there, they could get discounts or redeem points. And for the larger retailers that have their own sales channels online, it might not be necessary, but there's also, of course, tenants that do not have the resources to do that. And this could be an additional channel for them to create sales. And then again, for new mall developments, try to create as much semi or outdoor space as possible. Next. Well, what will retailers do on the short term is a bit of a repetition, but we see in Greece, not only in Indonesia, but also in the region in Southeast Asia, I would say, an increase in the amount of turnover rent. So sometimes that's with a lower base rent and a percentage revenue share, or it's a full revenue share scheme. So we expect that demand to increase over time going forward. They're continued to look to open standalone stores near residential areas. It's not a substitute for their mall outlets, but it's something they want to be close to residential areas to make sure they can deliver items easily, and they're closer to people that do not always want to go to a mall. We see, like I said, delay in handover and fit out of new stores. And we see retailers that continue to invest in their omni-channel strategies. That's direct channels, but also corporations with Shopee, with Tokopedia, Gojek, and Grab, and different segments of the retail market. They use different channels and they continue to invest in that. Next. So for the coming 6 months, what will be the strategies? Retailers will also continue to look for cheaper ways to expand in areas that do not have a presence yet. F&B retailers could go to cloud kitchens. Other segments like cosmetics, they might want to open up pop-up stores or kiosks that will serve to basically see how the market is doing there, but also serve as fulfillment centers. And there's a new phenomenon also in Indonesia, but also in Europe, we call dark stores, which is basically convenience stores just there to deliver items. And so these stores don't have to be in a prime location. That's something that we expect to see coming in Indonesia as well. Smaller stores, retailers will open smaller stores to save on rent and fit out costs if their concept allows them to. And then, of course, with the omnibus law, foreign retailers are also open to open smaller outlets, and the sizes differ per retail segment, basically. As said, closer to residential areas, and these stores will also serve as fulfillment centers, and we see that in the F&B sector, in the fashion sector, but also in the cosmetic sector. So that's what we expect for the retail market for the coming 6 months. Thank you very much.
Thank you, Sander, for the presentations. We'll move on to our next sector, which is industrial and logistics. We still have Bapak Ferry Salanto explaining about the market, and followed by Bapak Freddy Hidayat to explain about his opinion in regard to industrial and logistics market in the first half of 2021, and also opportunities and strategies in the remainder of 2021. Pak Ferry and Freddy, over to you.
Thank you, Auntie. Okay. Again, we are talking about the. I think this is one of the resilient sector compared to our sector. As you recall, Mike mentioned earlier in his speech, we at Colliers believe that the industrial market will be the first sector recover compared to the other sector. You might not see here in the chart. If you look at the annual absorption chart here, the sales is only not even reaching 50% of the total sales of last year, but we believe that inquiries and interest in the industrial product, including land and building, are still there. So meaning that we still see potential pent-up demand in the future, and it will continue in the favorite location or established industrial location in greater area of Jakarta. In terms of the supply, we see that the existing industrial developer are still expanding, especially in Serang, where 2 industrial assets is expanding because they are approaching or getting near to the existing port there. And then in Bogor, where there is no limited land to expand, we see that some industrial developer are expanding to Sukabumi area, which is further south area of the south of Greater Jakarta. And then we also see that the eastern area with the expected future Pantiban port, this will be the new industrial area connected with Karawang and Bekasi area. Next, please. In terms of type of active industry, during the first semester of 2021, we see that the automotive still leads. This is mainly because the big transaction happened in Greenland area. But the interesting one to see is that data center is also expanding, and this will continue to propel the transaction in the second semester or even in the next year. So we are expecting to see this technology kind of industry will still be the main driver for industry. Not only that, we also see the expansion of the e-commerce industry that will be trigger the need for logistic and warehousing, and also the other traditional sector like food and logistic, automotive, petrochemical, FMCG, and medical industry. I think that's all from me. Over to Pak Freddy.
Thank you, Ferry. Now, I'm going to talk about the market updates. For new investment, I think the market is still currently will be flat and will continue to be flat towards the end of the year. The existing tenants or investor will be more careful to expand their business, especially if their product is not considered as non-essential products. But we are expecting growth from data center, like Pak Ferry said, due to digitalization. We also have been receiving inquiries from data center clients for the past months, and most of these data centers are colocation data center. What I understand about this colocation data center, it will take some time for them to make decision to buy a property because they need to secure the tenants first, and then after that they buy the property. It is a little bit different than hyperscale data center, which they will use and operate the data center by themselves. We are also expecting growth from existing FMCG company, warehouse requirement from e-commerce and logistics. And regarding the PPKM or restriction towards community activities, it happened since 3rd of July until 2nd August. I think there will be no effect on the essential and critical sectors because they still can continue to produce the product with very strict health protocol, but the PPKM may influence other non-essential sectors. Okay, next slide, please. And what we can see for the opportunities during this situation, I think developers or investor with good capital should be able to acquire an attractive property available in the market. Perhaps you can get a property with a good price, with good location. And also in the meantime, the developers can also prepare the new expansion area. So when the market bounce back or starting to increase, the developers already prepared to sell and deliver the property. Next slide, please. So what's changing in the market right now is we can say it is still tenant market. Since last year, the developers need to be more flexible, give an attractive offer to get the client to buy the properties. For example, in case like some property owner is willing to give increment with the lease rate, as long as the client is still willing to extend the lease or give flexibility with the payment terms. In general, business is affected by the COVID, but not for essential and critical business such as logistic, food, and pharmaceutical. And for the next second half in 2021, I think we all know it has been challenging for the developers to get the buyers during this period of time. But generally speaking, since it is still tenant market, the developers and investors should be able to find some good property in the market, should actively be looking available property. Perhaps you can get the property with a good price, or maybe you can get a property in a good location. because I think the price may not increase toward the end of the year, or maybe you will be able to get a good deal from the property owner. Yeah, I think that's all for my presentation today. Thank you for joining the webinar.
Thank you, Freddy and Pak Ferry. And we're moving on to the last sector of today webinar. It will be apartment and hotel market. We still have Pak Ferry will explain about the market updates or reports, and also followed by Bapak Steve Atherton to present his findings on what happened in the apartment and hotel market. Pak Ferry and Pak Steve, the floor is yours.
Okay. Again, this is one of the sector that experienced quite a tough time, not only during the pandemic, but even prior to the pandemic, which I show you later in the chart. This is basically presenting the cumulative supply, and the number above is basically the supply coming in of each of the year. So this is the annual supply information. As you can see, 2020, the supply was relatively small, or even quite small compared to the previous years. That's also reflect the confidence among developers. Not many developers are introduce their project during the year of pandemic 2020, and then even this year 21, we see that the projection is also quite small compared to the year before 2019. Next. Okay, this is the overall performance of apartment sector. If you can see from the chart, the annual absorption has been quite low for some years. So that reflects that the situation for apartment transaction is not really because of the pandemic. Even prior to that, the trend has been quite in the declining trend. And then strata title pricing is also quite stable year on year. If you can see the below chart. And then from the occupancy, that's also reflect that the number of expatriates who has been fueling the apartment sector for some years, not too many. And then some company are also reducing their budget in their for their expatriate or their top management. So that's what makes the overall situation is quite tough for the apartment market. Next. And also for hotel, this is one of the most heated sector after retail for sure. If you look at the occupancy in Jakarta is relatively better than the occupancy for hotel in Bali, because the Jakarta we still see some activities, not only from the government or from the private corporation that compose the most of the guests in the hotel sector. But now I think what we see because of the discount that the hotel gave, the FIT market has also quite helping the occupancy to recover, but still it hasn't reached the normal time, if you can see from the chart there. So in overall, the market are still tough. But again, for this hotel and retail sector, we believe that this is only needs some time to recover. Once the economy recover, once the herd immunity is achieved, we don't see many reason for hotel to grow, because there is no more oversupply expectation from this sector. That's pretty much it from me. Thank you. Over to you, Steve.
Thanks, Ferry. Yeah, my comments beginning with the apartment section. Demand has remains soft from end users, from investors, and from tenants. So it's a challenging time for developers with standing inventory, and perhaps even more challenging for developers that have projects that haven't completed construction or are midway through construction. It's difficult to get new buyers across the line, no doubt. The rental demand for co-living, which is one sector we've been watching closely, is still there, but we don't see the players taking rapid action. The demand side for living in apartments, even with an attractive lifestyle or culture and so forth, while that is attractive, the demand side is still not there because people are not back at work and income is less predictable. So we've seen some delay still in that co-living space. Also, we have the issue of cost of debt in Indonesia. It's still quite expensive compared to other markets, like Singapore and Thailand, which are comparable markets for us. We might be able to get debt today from local banks in Indonesia rupiah at 8 to 10%, but we're going to be 3, 4, or even 5 points lower in these other markets, which is a great advantage for them. For apartment market, we have seen some good developers using this time to reconfigure their buildings. So if they designed a building 2 or 3 years ago with larger units, they're using this time to reconfigure and work with their architects and interior designers and figure out smaller unit sizes where they can come up with smaller total consideration prices. So buyers are more able to afford their units. Overall, too, we see that service apartments, while the occupancies and the rentals per square meter have dropped during this COVID period, they're still performing really pretty well as an asset class, especially when you compare to office at this present moment. On the hotel side, we have seen hotel debt being acquired by some credit funds, and they're looking to divest. It's not always easy for them to find serious and qualified buyers. So I think there's some opportunities in this area, especially for asset manager, direct hands-on owner types that could invest and perhaps even joint venture with some of these investors that are looking to divest. On the hospitality sector, of course, we're relying only on the domestic market until the business and holiday travel for foreigners reopens. This is a very challenging period of time, and we just need the vaccination and the herd immunity to really kick in before there's going to be the confidence to open up borders and get that traffic again. We hope that comes as soon as possible. We are seeing an interesting trend. Some of the global hospitality brands are beginning to talk with us about franchise deals for hotels and branded service apartments. So typically in Indonesia, most of your hotels are managed contracts with the brands. So they're providing all the people and running the hotels. But now, like is done frequently in the US, owners have the opportunity to do more of an a la carte menu, and they can work with a brand and get the name of the brand, maybe use their different technology and so forth, and then provide all of the people themselves. And maybe they could make a little better margin if they're an experienced player and have the ability to manage that way. And we are seeing a few villa resort projects like in Bali and plans for Lombok and some of the Gili Islands, where very smart projects are being planned of villa type resort developments with 5-star amenities. And these villas are selling, for prices ranging from 200,000 or 300,000 up to 800,000 or $1 million for a real lifestyle type of property. And many of the buyers are from Hong Kong and Singapore, and they might use the property for one month a year, and the balance of the year, all of that inventory would be put into the pool and managed by a professional management company. And again, along with really high quality, interesting F&B concepts, rooftop bars, a real lifestyle place. So that's looking pretty exciting for a few players that are in that space. Next slide, please. So what are some strategies for 2021 second half? I think for apartments, again, like Sandra had mentioned, in the retail space, the design, making the design more attractive in terms of creating, natural airflow, separations, how people can move and interact within a space, use of touchless devices. These things are going to become differentiators and really important to pay attention to as you design new projects. We think co-living really will come around. People are going to come back to the offices, and co-living, I think, is a concept that will be attractive because of the amenities and the type of lifestyle and culture that developers and investors in this co-living can create. And then I think TOD going forward is going to continue to be a very strong space. It's going to be a game changer with the MRT and the light rail transit finishing up sometime in 2022. So we're going to see, I think, investors and end users and developers all focusing more on really strong locations close to stations. Lastly, on the hotel side, vaccination is going to be the key for opening the borders and getting the hotel market recovery in place. I think it's really important for the hotels to continue to focus on customer relations and adopting really flexible rebooking programs when plans are delayed because of PPKM programs and whatnot. This franchise hotel model opportunity for service apartments as well as hotels is going to be something that can be very attractive for experienced operator hotel owners. And maybe the last thing you can do if you have the cash and the capital available is to renovate or improve your property and your operations during this time. But as they say, mountaintops, when the times are really good, those are for encouragement. And the valleys, when things are really bad, those are times for maturing. But we all know property market is cyclical, and these challenging times will not last forever. So as it has been said in many difficult times in the past, this too shall pass. Thank you very much for attending today.
Thank you very much, Pak Steve, for a very positive note to end the presentation. So we'll move forward to our question and answers session. We've received quite a few questions, but I will try to make it compact. So we're going to address the question per sector, so it won't go, back and forth. The very first one will go to both Ibu Monica and Pak Steve Atherton. So it's a question from PT Jogja Solo. Will the situation in 2024 the same like it was before in 2019? And which sector that you will think will be the most promising in 2024? Pak Steve and Ibu Monica?
Okay.
Ladies first.
Thank you, Pak Steve. Yes, as we have mentioned that taking into account the speed of vaccination and also the supply, we expect that the fastest growing for property market is in the early 2023, but it will be slightly going very slowly. So yes, maybe in 2024 we expect that it will be the same to 2019. But remember, actually 2019 was not actually the peak period for property. Because in 2019, some sectors also had the tight competition, oversupply condition, and others. So 2024 is, it could be similar to 2019, but it doesn't mean that it is the peak period for the property. In terms of sector, it won't be slightly different from what is actually happened currently. It will be still a certain sector for industrial, so like data center, logistic, and also cold storage, and also landed houses, because landed houses are still demanded type of property sector. So this is actually my my opinion. So maybe Pak Steve, you have some additional information.
Okay, thank you, Monica. Yeah, as I said earlier, property markets are cyclical, and these challenging times will not last forever. As I look at the sectors that are currently facing the most challenge, like office market, I'm bullish that in 3 to 4 years' time, the office market's going to be back strong. I don't think people will want to continue working from home all the time. They want to work in collaboration with their coworkers and have community. And if you look at what's happening even right now in China, Korea, Japan, Hong Kong, you're seeing office buildings trade, and you're still seeing new big leases being signed and announced. So, you know, the office market isn't over forever. It's going to come back. And as Sander said, there's opportunities for retail developers to create more outdoor type spaces that are creative, that people will enjoy, dining, F&B, lifestyle. Certainly hotels is an asset class that I think when COVID's over, hotels going to pop back very quickly. Hotels going to recover very strongly. And lastly, apartments seems to be the section that's the most out of favor. But are people not going to want to live in apartments anymore? I don't think so. Apartments are going to come back. It's all cyclical. And I think for the Main Street type of player that has money, they could be talking to developers and probably striking really good deals today. And by the time we get to 2024, I think the apartment sector will be back strong. That's all I have for you. Thank you.
Thank you, Pak Steve. On that note, since you mentioned about apartment sector, just a quick run. We have a question from Ibu Hizkia. For developers who already, have an development or apartment to be developed, should they just launch it, or should they postpone and wait for the market to be back to somewhat normal?
Is that for me, Auntie?
Yes, Pak.
Oh, okay.
Correct, Pak.
I would say this is a time to really get close to your customer. If I were owning a piece of land that's planned for an apartment project, I would be interviewing potential buyers. I'd be looking at who my target market is. Like, is it millennials? Is it older couples that children have moved out of the house and they're looking to downsize? And I would be interviewing them, and I'd be finding out what they're looking for. And I would get some pre-sales established before I started, in this environment that we're facing at the present moment.
Okay, noted. One more question for Pak Steve and Ibu Monica. What do you think? It's from Sasha Schwarzkopf. What are Colliers' thoughts on the idea of building repurposing? Because since the commercial or office market is quite soft and will remain so, there is a decent amount of Class B and C structures along the Sudirman corridor that could be ideal for repurposing, given the amenities of the Sudirman corridor offers. And repurposed building could offer a building owner a new life in its asset management. What are Pak Steve and Ibu Monica thoughts on this? And maybe later on, Pak Bagus.
Ibu?
Yes, it could be also potential, but again, repurpose will give some positive advantage for the developer, like a new trend, or maybe also new environment and new atmosphere. But we still have to check about the demand, because what type of demand that is still available for that location. Because if we mention about if we revert to the CBD is still for those commercial market. So that's why, and currently commercial market is not that high demand. But yes, after the COVID, maybe there will be some demand for that. But again, if we mention about the CBD, then it should be like a mixed use development, not really like a one block, because it also refers to the zoning of the development. It is my thought, Steve.
Yeah, we've seen some clients like that are looking for repurposing. Like the end use they're targeting is like serviced apartments, and they're looking at older office buildings as a potential building to be repurposed. But the challenge is finding the building priced at a level that will give the investor the yields they need. So we think people are interested in that and they're exploring it, but it's been hard to find deals that make economic sense. On the other hand, some new buildings, like new office buildings, we have been talking with a few investors that are looking at conversions, for example, into healthcare type use of office buildings. And certainly, in the US, and I think more and more in Asia, we'll see older retail locations, maybe in like B- or C locations that can be used for logistics. So maybe some combination, some mixed use where you get logistic last mile fulfillment centers in locations maybe where before it was a department store that can't trade very well anymore. I think that's all I have for that. Thank you.
Thank you, Pak Steve and Ibu Monica. Pak Bagus, do you have any thoughts before we move to the office sector, probably for this?
Yeah, just adding to the comment from Monica and Steve. The challenge right now is it's not about the occupier of the space. The challenge is the business is disrupted right now, right? So the challenge is the economy is slowing down big time, right? So those buildings that are built along Sudirman or Tamrin are the building where the TOD line is, MRT line, LRT line, right? Commuter train, it's all going to be connected. So actually what the job that we have to do, especially government, is how to deal with this pandemic very soon and achieve the herd immunity as soon as possible and get the economy back on track again. And then once we have those, this building that is right now oversupply, yes, and is still going to be continue added, yes, 2022, 2023, it will be completed. And then demand will start to catch up once this herd immunity is solved and created, and then economy back into normal and GDP growth goes back into a higher level. So that's what we're waiting for. And hopefully within 2 years time, the maximum we should be able to achieve that. Then all these business and offices, even though they're still applying working from home and working from office, it'll start to come back and catch up. That's what I believe.
Okay, noted, Pak Bagus. Thank you for the additional comment. We'll move to office sector. We have a question, so I'm going to group this question because quite a lot of question to cover. From Ibu Lini Susanto and Pak Greg Wiyanto. So the first one is Pak Bagus, would work from home affecting office demand in the long term? And also to add to that question, Ibu, do we ask if we will ever back to the pre-COVID era for office?
Yeah, this is the thank you for the question. It's actually a good question. Working from home is not ideal. It's not something that people prefer to do. I mean, we're people, human being. Right? We love to interact with each other. We like to have physical interaction, social interaction, right? Meeting in the cafe, dinner, and all that. But we just don't have those options right now, right? So So working from home is something that we have to do, we are forced to do, right? Yes, it does affect the demand, because right now people reduce the space, companies reduce the space, and the space that is reduced added to the supply, right? So back into my first comment early on, right? So how to make sure that this COVID-19 pandemic is solved and issue within a short period of time. Then, even though people still continue working from home probably for a while, then at the end, human beings, right, being like to interact, so they'll go back to the office. Because I remember there's a research that Colliers done many years ago when there was a Spanish flu, right? So they work from home, and then after a few years they forget about it and go back to the office again, right? So it's hard to say when is this working from home is going to stop or continue. It's hard to say, you know, but that's the best solution right now, hybrid between working from and working from the office, you know. So what is the second question again? I forgot.
Will we ever go back to the pre-COVID
Oh yeah,
situation, Pak?
definitely, definitely. It will go back to pre-COVID when they mention pre-COVID. So I'm actually referring more into the booming of office market in 2011 and 2014. So I think we at the time, office market really turned around, and then we achieved rent at 30, 40, even $50 per square meter per month during those 2011 and 2014. It will take time to go back there, but what you're talking about 17, 18, 19, definitely we will achieve that for sure. But to 2011 and 2014 office performance, it'll take a longer time. But at the end, once pandemic is all over, Indonesian economy go back to normal. As McKinsey had said, right? Indonesia will become the 7th largest in 2030. That's what I believe. We support those ideas. That is why we hope that we can deal with this pandemic. Herd immunity will be achieved. Then things will go back to normal again, and office market will achieve the great performance 2011 and 2014.
Thank you, Pak Bagus. Next question for office from Bapak Igor. Why consistent new supply despite the oversupply? Does landlords making money or only break-even point, Pak?
Okay, all this. Thank you for the question again. If you follow the office market was booming 2011 and 2014. Okay, and then it was so booming, it's overachieved where it was prior to 1998 Asian financial crisis. So before 1998 Asian financial crisis, right? The building grade A premium was transacted at probably $22 to $27 per square meter per month, base rent excluding service charge. And then 11 to 14, we could do a transaction, the similar quality of building at $30 to $50, right? So this report of great performance of Indonesian market for office has been discussed internationally, right? So not only local that start to build office building during this period of time, 2011, 2014, but also international players comes into the market and then find opportunity, right? So they found opportunity. So you will start seeing, right? Many international players, not only the owner of Senayan, Kajima, not only the Singapore investor Capital, and we have a lot of owners, a lot of foreign investor comes in, right? So they're building, they execute and they build. And then hoping to see that the office market is gonna keep growing. But unfortunately, we have this setback, right? March 2020, unfortunately is declared, we have this COVID situation. And now we are having a tough time right now, but it will turn around, right? I always believe, and it has been proven in other great cities, that along MRT line, there will be a premium. So those premium, yes, hasn't happened yet, but once economy back to normal, our growth GDP is growing, and Indonesia is continued to grow as a maybe 7 or even better largest company in the world, then the owner of the office along those MRT line, LRT line, close to commuter train will get premium. That's what we yet to see, and we believe it will happen that way too. So that is why there is still supply, yeah, because of that. Because foreign investors already injected and already signed the deal. And then the nature of foreign investor, when they sign the deal, they continue. And they're thinking long term. It's not only 5 years, 10, 20 years, right? Even recently, I don't know whether you follow, Taspen and Mitsubishi Estate signed the deal in Sudirman, right? At the current challenging office market. Why? Because they believe it will turn around, it'll come back. Thank you.
Thank you, Pak. Next question, still from office. From Ibu Dwi Novitayeni, for strata title office space for rent, is it as competitive if we compare with the rental office? And for the demand, because the demand is, it decreased up until 80%. What about the demand for strata office for lease?
Okay, it's different target market between tenants for pure lease office building and tenants for the strata title space. It's because the nature of the building itself, right? So many multinational companies don't like to go into strata title space, but some okay to go to strata title space. So it's different approach and opinion on those. So strata title market is being offered as attractive rent by many owners because those owners have been paying service charge, right? So have been paying service charge on an empty and vacant space. After a while, they have concern, right? So that is why the office market is currently oversupply and rent is currently very competitive. So right now, by giving a very attractive rent, sometimes it's even most of the times is slightly lower than the office for lease, depending on the size and depending on the name of the tenants. Then the benefit of the strata title owners, they get the tenant pay the service charge. So not only they get quite income from the base rent, but also they don't have to pay the service charge. So the way they look at it is they get the base rent and also somebody else pay the service charge. They don't have to pay out from their own cash. Now, in terms of the demand, is for the strata title owners, which could be companies, could be individually, compared to pure lease office building, is also two different market. So the way I see it, right now, the below 80% that Pak Ferry has mentioned is a combine between lease and strata all together, So, but strata title market for us is not easy to accurately penetrate in accurate way whether or not the space is taken or occupied fully or partly occupied. So we only know until the owners open into the market that, okay, I buy one floor, I only take half, I'm gonna rent the other half, So then we know that we put it in our market, So that is why it is if you're talking about the demand for strata title compared to demand for the pure lease, the tenants that are right now looking for office space, they focus more right now for the leasing office compared to the strata title office building.
Thank you, Pak Bagus. We'll move to the next question. I think this will be the last one from office, and we'll answer the rest through email. This came from Pak Yap Tetfa. Pak Yap Tetfa asked, the first one is due to how to anticipate strategy, especially due to WFH and hybrid policy. And secondly, rent fee is decreasing. Is price the only main driver, or do you see other factors that can be valued by renter, such as green building, service excellence, facilities? Pak Bagus.
In the past, whenever occupiers looking and assess the office buildings, between financial and non-financial could be 50-50. So when they run the analysis, the weight of financial 50%. So that means commercial terms 50% and the weight for the non-financial 50%. But now, because of the office market having oversupply and consider tenants market, so obviously tenant is trying to take advantage of that. So when they run the assessment of the office, now more into commercial, the weight is more into commercial, 70-80%, and non-financial 20%. So the green building, large parking lots, and large floor plate, double glaze, double surface lift, high ceiling height. So all those non-financial raised floor, is becoming less weight because of the current situation. But normally they value those, yes. So when market turn around, comes back, it will be added value for occupiers when they look for office space, and it will be value more for sure, because when market is back to normal, business is back to normal, right? Income is also strong, so they'll be able to pay rent, market rent, normal market rent. So for them, rent is no longer an issue. Financial is no longer an issue. It's more like non-financial. But this will only happen when market is back into normal.
Thank you, Pak Bagus. We'll move to industrial sector. Pak Freddy, the first question comes from Kali Nuzuli. Pak Kali asked how to make industrial estate who is far away from Jakarta to get competitive with other industrial estate that is near Jakarta, so they can approach data center company, Pak.
Yes, I think a few points that data center most concerned about is the infrastructure, such as power capacity, fiber optic connection, and other things like earthquake zone and flooding zone. So I think if we can promote those few points to the specific or clients that you're targeting, I think it will be more effective for them to check out, at least to do the site visit to the location.
Okay, Pak Freddy. And second, it is a question from Ibu Vera Raharja and also Bapak. Pak Ibu Vera asked, is cold storage market really grow? And is it only in Jakarta or also other cities?
The cold storage, I think it is still growing, and it is a good opportunity to explore. But the player in Indonesia, I think that not so much developer can provide this cold storage building because the construction cost is very expensive. I think they're more conservative to spend that kind of money to invest in the construction for the cold storage. And also it is also depends on the surrounding environment, such as the existing retail like supermarket, restaurants, hotel. Yeah, I think we need to be careful to to grab this opportunity, because otherwise, when you build the warehouse, the cold storage warehouse, but no demand in the surrounding area, so I think it will be useless.
Thank you, Pak Freddy. And the next still question for industrial is from Xu Chuin Chia. For data center inquiries and interests, where or which location are they focused in? And what is the profile of interested parties, like operators or end users? And how the supply matching up with demand?
For the area data center is looking right now, I think still in the surrounding Jakarta, greater Jakarta. Some of them looking for in the south part of Jakarta, like Sentul, Bogor, and some of them looking in the east part of Jakarta, like Cikarang, Bekasi, and until Karawang. And regarding the supply and demand, I think what I heard from the market, from the data center clients, I think they're thinking the growth of data center in Indonesia is still big. It is still a long way to go, because they can see there are so much digital platform right now. People, more and more startup company, they're trying to be the next unicorn of startup company, like Oppo, like Traveloka, Blibli. So I think what we can see, it is still a huge opportunity in the future. And also the 5G connection now, I think more and more people will use this digital platform compared to the previous years. Like we're updating status online every time we use the Instagram or YouTube, or yeah, I think it is still huge market in the future.
Okay, one last question for industrial sector. Still from Pak Yap Tetva. As you mentioned, this sector will be first to recover due to increasing demand in e-commerce, data center, logistic. What is your view on modern warehouse trend currently? Will this sector grow?
Modern warehouse right now, I think they are in good position right now, especially for those who already finished the building. Yeah, because the demand for e-commerce right now suddenly is picking up very fast, and we can say yes, the data center is finding there's an increased demand for data center in finding a property, but also the logistic, because FMCG, e-commerce, they need a warehouse to store their goods, right? So I think it is still good opportunity to explore for the modern warehouse.
Okay, thank you, Pak Freddy. We'll move to the next sector, which is retail sector, with Bapak Sander Halsema. Pak Sander, first question from Ibu Mamai. When will retail market back to where it was before COVID area, Pak Sander?
I think eventually, yes. It depends on the segment within the retail market. I think how quick they get back on their feet. I've been in touch with colleagues of mine in Australia, New Zealand, and also in other countries in Southeast Asia. What we do see is that especially the F&B sector is getting back on its feet relatively quickly. It seems that people really, if they're after a lockdown, people are really longing to hang out with friends and family, go out for food and dine. So that's a typical segment within the retail that is recovering fast. But also other sectors, you might see a shift in sales, of course, from offline to online. So online sales is increasing, obviously has been increasing over the last year and a half. But generally speaking, I also believe that people will continue to go to shopping malls. You might see a little bit of a change in terms of the tenancy mix. yeah, where you traditional retail like fashion and all that percentage might go down a little bit, a bit more F&B, a bit more experienced type of tenants. So you might see a change, a shift a little bit. But generally speaking, I think the retail will recover, yes.
Okay, thank you. Next question from Jesta Basha. What is a more sustainable approach for retailers than to close the old store and open a new one? Assuming once the pandemic is over, they will need to have their old store in the business center operating again.
Yeah. Well, I think retailers don't just close stores. They're looking at their portfolio in each area, or in, let's say, Jabodetabek, and they look at the sales performance of stores. They look at the cost of keeping it open. Of course, how long, the length of the lease that's still remaining, what type of landlord are we dealing with? So there's many factors, I would say, before they close a store that come into play. I mean, if you look at larger national retailers, F&B retailers that have a large presence in all areas throughout Jabodetabek, they might also think, okay, we cannot have people coming into the store, but can this store also serve as an online fulfillment center? And so it's just, they don't just do it overnight. It's just, I think, they look at the portfolio as a whole, and in certain areas, they might have 3 or 4 outlets and they close 1 or 2 of them, because it's probably enough to have just 2 to cover the area. And apart from that, I think there's alternatives right now that might also work, like cloud kitchens, for example, or opening up smaller, let's say, pop-up stores to test out an area first, or that can serve as a fulfillment center. So there's just alternatives that they consider that might be cheaper for them or work better for them in a certain area. And so I don't think they just close stores, but there's a lot of factors that come into play before they do such a thing. But generally speaking, of course, they have invested capital into every outlet. And so to just close it is probably not very wise. But because of the current situation, and to keep everything open is also very, very costly. But like I said, there's many factors that come into play before they make such a decision.
Okay. Thank you, Sander, for retail questions. I think we're going to go back to Ibu Steve and Pak Steve and Ibu Monica, because we still receive a few questions in regard to the investment atmosphere and apartment. Pak Steve and Ibu Monica, Ibu Foni Tresno Santoso raised a question. They are situated in Central Java. Should we halt all ongoing mixed-use projects, mall and apartments that is ongoing right now and continue after things turn around? I think Pak Steve already kind of mentioned about the apartment, but maybe you can kind of elaborate a little bit if it's some mixed-use projects in Central Java. Bu Monica, maybe?
Okay, I think Central, we have to admit that sometimes the property market is still sometimes centralized in Jakarta, Greater Jakarta, and after that then into Central Java. We assume that Central Java is maybe like Semarang, because a property is sometimes is centralized also in the province city. So the market actually is not really that robust like in Jakarta. So in current situation, if you do have some project like a mixed-use development, then yeah, it would be better if you just hold it for a while until the market is getting better. And during this period, then you still have to give some positive promotion about your project, that it is the waiting is not because the market is not that good, but because you are waiting until the situation is getting better in terms of the environment, in terms of the healthy situation and others. So with those positive promotion, then when you really do launching the project, then people started to be able to grab the potential market. This is actually my comment, Pasti.
That's a great answer, Monica. I don't think I could add anything to that. Thank you.
Thank you, Pak Steve and Ibu Monica. A follow-up question from Pak Alex Chong. Are there any incentive or initiative from the government to boost the depressed property market? Maybe Ibu Monica and Pak Ferry can help. Pak Ferry?
I think Pak Steve have some insight into the about the depressed assets. Pak Steve.
Okay, Pak Steve.
Well, in terms, I think most property owners would like to have more government support. Just in general, because their cash flow is difficult. It's hard to collect rents from tenants. So I think you hear from retail industry, from hotel industry, many sectors asking, can they get a break on, delay property tax payments or delay their 10% rental tax. They're requesting more and more help from government there, and they need help. So I have not seen any formalization of those kind of offers. But certainly other countries have done it where the government has the funding to be able to support business.
Okay. Last question, Pak Steve. This is for hotel industry. What is the situation of second market for hotel industry? It came from Pak Adi Priyatno. Pak Adi thinks that a lot of owners might want to sell their hotel now on. Your thoughts, Pak?
Okay, yeah, so for the secondary market, so that's an existing hotel where the owner would like to sell the property. There are a lot of hotel properties offered on the market right now. But many of the hotels are maybe in secondary locations, or the asset class itself might not be what is in high demand by the investors. We're working with a number of hotel investors, whether it's private individuals or institutional buyers, owners, and private equity funds. They tend to really target larger ticket price hotels. I mean, they want to spend $10–15 million US up to $100 million. So a smaller hotel asset that's $3 or $4 million isn't gonna move the needle much for those types of players. But those are gonna fit better for domestic investors. And we do see domestic investors looking, but again, it tends to be looking for specific types of assets, like a villa style hotel in Bali, or something that is going to be an asset that they can own and manage and maybe add value and increase.
Okay, Pak Steve, thank you for the answers. To all panelists, thank you for the answer. I think we should wrap up our webinar session because we're already 15 minutes more than we should have. So we just want to remind everyone that we will send out a link to access the recorded webinar along with the presentation slides to your email inbox. If you have any question, do not hesitate to contact us. All of our experts or panelists today has their own QR codes in your screen. You can just scan it and save their contact number. And also, if you want to maybe subscribe to our reports. We have a quarterly reports. You can also scan the QR code, and please do help us in fill out our webinar survey, and appreciate your time so that we can improve our webinar in the future. Until then. Thank you for your attending in the webinar session, and we'll see you in our future webinar. Until then, stay safe and healthy. Bye-bye.
Thank you.
Thank you.
Thank you.
Thank you, everyone, for attending.
Thank you, everyone.
Thank you, everyone.